Hi, I'm Savita Subramanian, Head of U.S. Equity and U.S. Quantitative Strategy at BofA Merrill Lynch Global Research. Well, with a very strong first quarter, we get the question, what drove performance in the first quarter and what's coming up next? The first quarter was really more of a risk-on type of a trade where equities and the riskier assets really enjoyed significant returns. We saw the S&P 500 return about 11%, which is normally what you see over a full course of a year. The strength of the market in the first quarter was really driven by a relief rally based on some positive economic data and some positive news coming out of Europe. Now, what's next? Well, the future looks a little less certain. The second quarter, I think, could be more of a risk-off type of a quarter where we see a little bit of a give back in equity returns. There are certain pockets of the market that appear compelling and could continue to outperform. For example, companies that are returning cash to shareholders have, and we think should continue to generate capital appreciation. We found that companies that are paying and growing dividends, buying back shares, or engaging in strategic M&A should continue to outperform the market. The second theme that we really like is focusing on higher quality stocks rather than lower quality stocks. By quality, what we're looking for are companies that have exhibited a track record of generating stable cash flows. Again, in an uncertain world with a lot of macro risk, we think that companies that have delivered and should continue to deliver will be rewarded and will outperform the market. Finally, technology is one of our favorite sectors. It's got cash, it's got stable growth, and instead of every other credit-sensitive sector that has created capacity over the last decade, tech has actually consolidated capacity and is actually in a much better place today than a lot of the credit-sensitive sectors. For the long term, equities could actually be a good place to be. A lot of what's driven equity performance over the last few years has been less about fundamentals and more about the macro backdrop. But over a longer term period, we found that fundamentals do matter. And given the health of corporate balance sheets in the U.S. and the general ability of U.S. corporates to generate earnings growth, we think that equities could actually do quite well over the long haul. Valuations certainly support this. If you look at current valuations today, the market is trading at a much lower PE ratio than it was back in 2000. So if you bought the equity market in 2000, you wouldn't have done that well. Today, valuations make a much more compelling case for buying the market.